Risk management in arbitrage trading. Risk management is essential to successful arbitrage trading. While arbitrage is often seen as low risk, several factors can turn a seemingly risk-free trade into a loss if not managed correctly. 1. Execution risk. Execution risk, also known as slippage, occurs when trades are executed at prices different from those expected when the arbitrage opportunity was identified. This risk is particularly prevalent in fast-moving markets where prices can change rapidly in the time it takes to execute a trade. For example, let's say you identify a price discrepancy between two exchanges for a stock. You place a buy order on one exchange and a sell order on the other. However, by the time the orders are executed, the prices may have shifted, reducing or even eliminating your profit margin. This is especially true in high-frequency trading, HFT environments, where even microsecond delays can lead to missed opportunities. The key to mitigating execution risk is to use automated systems capable of executing trades at lightning speed. Many arbitrageurs rely on algorithmic trading platforms that can process trades faster than any human could, thus reducing the likelihood of slippage. 2. Liquidity risk. Liquidity risk refers to the inability to execute trades due to a lack of buyers or sellers at the desired price. In arbitrage trading, liquidity risk can arise if a market becomes illiquid just when you need to close a position, leaving you with unwanted exposure or forcing you to execute at unfavorable prices. Liquidity risk is particularly high in smaller or thinly traded markets, such as emerging markets or certain cryptocurrencies. Even in highly liquid markets, temporary liquidity shortages can occur during market stress or volatility spikes. One way to mitigate liquidity risk is to focus on trading in markets with high trading volume and deep order books. Another approach is to diversify your arbitrage trades across multiple assets and markets so you aren't reliant on the liquidity of just one or two markets. By spreading out your trades, you reduce the chance that liquidity problems in one market will derail your overall strategy. Traders should also monitor liquidity conditions in real time to react quickly if market liquidity begins to deteriorate. 3rd, counterparty risk. Counterparty risk, also known as credit risk, arises when the other party in a transaction fails to fulfill their obligations. In arbitrage trading, this risk is most pronounced in over-the-counter (OTC) markets and during transactions with lesser-known or unregulated exchanges. For example, if you enter into a trade to buy an asset from a counterparty in one market and sell it to another party in another market, there is always the risk that one of the parties might default on the agreement. This could result in a partial or total loss of capital. To mitigate counterparty risk, traders often prefer to trade on regulated exchanges, where transactions are more likely to be honored. Regulated exchanges often require counterparties to post collateral or margin, which acts as a buffer in case of default. Traders should also perform due diligence when dealing with counterparties, particularly in crypto or forex markets, where counterparty risk can be higher. Another effective risk management tool is the use of clearinghouses, which act as intermediaries in trades. Clearinghouses reduce counterparty risk by guaranteeing both sides of the transaction and ensuring that trades are settled properly. 4. Currency risk and hedging strategies. Currency risk, also known as foreign exchange (FX) risk, arises when trading across different countries or regions with varying currencies. Even if the arbitrage opportunity appears profitable, fluctuations in exchange rates can erode or completely eliminate potential profits. For example, if you are arbitraging between the US and Europe, any movement in the exchange rate between the US dollar (USD) and the euro (EUR) could impact the final outcome of the trade. If the USD strengthens after you've entered the trade, the value of the EUR you're holding decreases, reducing your profits. To mitigate currency risk, arbitrage traders use hedging strategies such as currency forwards, futures, and options to lock in exchange rates. These instruments allow traders to offset potential losses caused by adverse currency movements, but they come at a cost. Traders need to carefully assess the cost of hedging versus the potential benefits. Traders may also use currency swaps, which involve exchanging principal and interest payments in one currency for those in another. Swaps help traders maintain liquidity in the currencies they need while reducing exposure to FX fluctuations. 5. Interest rate and cross-asset hedging. Interest rate risk is particularly important for traders involved in fixed income arbitrage, where small differences in interest rates between markets or securities can present opportunities. However, changes in interest rates can also pose risks, as fluctuations may impact the value of the underlying assets. To manage interest rate risk, arbitrage traders use interest rate swaps, futures contracts, or forward rate agreements, FRAs. These tools allow traders to hedge against changes in interest rates, ensuring that their positions remain profitable even when rates shift unexpectedly. Another important risk management technique is cross-asset hedging. In this strategy, traders hedge their exposure to one asset by taking an offsetting position in another correlated asset. For instance, a trader might hedge a long position in oil with a short position in the Canadian dollar, CAD, given that the two tend to move in tandem due to Canada's reliance on oil exports. By diversifying across asset classes and using hedging techniques, traders can limit their exposure to unexpected market movements. 6. Volatility and tail risk. Hedging market volatility while presenting arbitrage opportunities also introduces significant risk. Volatile markets can cause prices to fluctuate wildly, potentially resulting in unanticipated losses. Volatility risk can be managed through the use of volatility derivatives, such as VIX options or volatility swaps. These instruments allow traders to hedge against sudden spikes in volatility, ensuring that their positions remain insulated from wild price swings. Another risk management technique is tail risk hedging. This involves purchasing protection against extreme market events, often referred to as black swan events. Tail risk hedges typically involve buying deep out-of-the-money put options, which will only be profitable if the market experiences a severe downturn. While these options are relatively cheap, they provide significant protection during times of market stress. 7. Funding and leverage risk. Leverage is a double-edged sword in arbitrage trading. While it can amplify returns by allowing traders to control large positions with a relatively small amount of capital, it also magnifies losses. If a trade moves against the leveraged position, losses can exceed the initial capital invested. In addition, traders using leverage are often subject to margin calls, where they are required to post additional collateral if the value of their position drops. Failure to meet a margin call can result in the forced liquidation of positions at unfavorable prices, leading to significant losses. To manage leverage risk, traders should use conservative leverage levels and set stop-loss orders to automatically exit a position if it moves too far against them. 8. Regulatory and legal risk. Regulatory and legal risk arises from changes in government policies, tax laws, or financial regulations that can impact arbitrage opportunities. For instance, new tax laws or capital controls imposed by a government could make certain arbitrage strategies less profitable or even illegal. In recent years, cryptocurrency arbitrage has been heavily scrutinized by regulators. Some countries have banned or restricted crypto trading, while others have imposed strict tax laws on digital assets. Staying informed about regulatory changes and adjusting strategies accordingly is crucial to avoiding legal trouble. Traders should also be aware of reporting requirements in the jurisdictions they operate in. Many countries require traders to report large transactions or positions to regulators. Failing to comply with these rules can lead to fines and penalties. Risk management is not just a precaution in arbitrage trading, it's a fundamental aspect of a sustainable trading strategy. While arbitrage is often seen as a low-risk venture, the reality is that no trade is without risk. Execution delays, liquidity shortfalls, counterparty defaults, and unexpected market movements can turn a profitable trade into a loss within seconds. This is why having a well-thought-out risk management strategy is essential. The key to long-term success in arbitrage lies in identifying and assessing risks up front. Knowing the types of risks you face, whether it's execution risk from slippage, liquidity issues in smaller markets, or regulatory changes in different jurisdictions, allows you to craft strategies that are proactive rather than reactive. Risk management is not about avoiding all risk, but rather about mitigating it effectively so that losses are minimized and profits are protected. Incorporating hedging strategies such as using currency forwards or volatility derivatives can further shield your trades from external forces like exchange rate fluctuations or unexpected market volatility. Hedging ensures that even if the market moves against you, the damage is limited.